A warm welcome to the first of a series of webinars about the European real estate markets. My name is Jürgen Fenk, and I'm the CEO of Primonial Real Estate Investment Management. I'm dialing in from a very stormy Berlin, so please excuse the background noise. We are all very happy that you joined us this morning. Primonial REIM's research experts will lead you through a pan-European real estate outlook. And we will speak about the current market environment, especially the macro environment, the European real estate market dynamics. We will have a look at specific asset classes like German healthcare, Parisian offices, and European residential. And we will finish with some Q&A. And please feel free to ask questions through the chat function during the session. Before we start, I would like to give you a very brief description who Primonial REIM is and what we do. With a bit of more than 32 billion assets under management, Primonial REIM is a key European real estate asset manager. Our strength lies in our multi-local presence. We are actually present in 4 countries. Our teams are central to our business in every country and are as close as possible to the specific markets to give our clients access to the best investments. We rely on conviction-based management strategies and in-depth knowledge about the various sectors, considering macro and microeconomic trends, the main social trends, and demographic and sociological changes. As you can see on this slide, we provide asset and property management services to retail and institutional clients through a variety of products in all major asset classes. We are invested in 10 different countries, predominantly in France, but we have a clear strategy to further increase our footprint in all Europe. Our commitment to society and the environment has been part of our history for 10 years and is an important pillar for our investment decisions. With that, I would like to introduce you to our great European research team and will hand over to Danielle, our head of research, strategy and sustainability. Danielle, the floor is yours.
Thanks, Jürgen. Great to be here. Welcome to everyone. I'm Daniel Weil. I'm head of research, strategy and sustainability for Primonial REIM. We have a team, a pan-European team, on the research side, which is led by Henri-Aurélien Natter, head of research of Primonial REIM, who produces a quarterly outlook on real estate markets, European real estate markets, through all asset classes, and always with an investor's point of view, because we believe that it's important to have an investor's point of view on, and an allocator's point of view, may I say, on the real estate markets, especially today. So you can download our comprehensive studies and quarterly outlooks on our website. And we are joined by Florian Wenner, who is based in Frankfurt, who is our senior researcher and who is focused on the German markets, all asset classes. It's very important to us to have a macro view, but also a local view, and have people on the ground who really know the dynamics of the real estate markets. As we know, location. So it's really important to us to have both the macro view and the ground view on real estate, and that's what we're trying to have in our research. So I'm going to walk you through the convictions and a few insights we have on the current macro environment and the impact it has on the real estate European markets. And then I'll hand it over to Henri-Aurélien, who will go into further detail on real estate markets. So if we have had this conversation 2 years ago, the question would have been, will it be V-shaped recovery, W-shaped recovery. Will there ever be a recovery? We didn't even know at the time. Now, 2 years after, we can say it's a V-shaped recovery with, let's say, a square root characteristics, with, of course, a big recession in 2020, as you all know, -8% in France, -6% in Eurozone, then sort of a mechanical rebound in 2021. And the question that is still open in our view is, after the pandemic has been absorbed, will we stay on a usual rate of GDP growth, which is under or above the pre-pandemic levels? That we still don't know, since there's a burden of debt, of course, which typically is a limit to growth. But also we can see that there has been tremendous money injected into the economy, and we still need to see how this translates in terms of economic growth. And then, of course, there's inflation, which is the big topic of the moment. As you know, we've seen some rise in inflation rates, especially in the United States, but also in Europe. So it's a big debate now, and I thought it was interesting to try to elaborate on what's really the relationship between inflation and real estate. What the literature says is that, first of all, we have to differentiate inflation that is driven by the rise in costs, typically, of course, commodities costs, oil, paper, etc., bottlenecks in supply chains, and differentiate it with inflation, which is pulled by demand, which we will call overheating, which is typically the 1960s, 1970s inflation we all have in mind. It's a very different kind of inflation, and what's difficult to read in the current environment is that we kind of have a bit of both, because of course we know that the current rise in inflation is the consequence of supply chains that have been really hit hard by the pandemic, and of course they have to, as economies reopen, they have to protect their stocks, and prices rise mechanically. And also there's the oil issue, which of course has many sides to it, geopolitical, etc. So clearly we're seeing a cost push inflation today, and that's what I would call bad inflation for real estate, because of course, even though you could say that as rents are usually correlated to inflation through indexation, in the real world there's a negative effect of that kind of inflation, because it affects tenant solvency, and the free leases and all the concessions that we make to keep our tenants, they tend to rise in that case. And of course, when you've got a degradation of cash flows because your tenant solvency is hit by costs rising, well, of course, degradation of cash flows is bad for real estate values. But we've also got a fraction of demand inflation. And that's, of course, the effect of quantitative easing. And it's very difficult to differentiate the first from the second. And demand inflation, demand pull inflation, is good for real estate until a certain point where interest rates have to be risen. But basically, demand pull inflation has a positive effect on values and rents historically, statistically, provided there is no big rise, big interest rate hikes to stop that inflation from becoming out of control. So that's a bit where we are now. Of course, the discourse of the Fed and the ECB is rather not in favor of rising interest rates. Of course, we don't know yet if inflation could go out of control. We don't know yet if the fraction of inflation which is due to rising costs and which is probably temporary will have more consequences on the inflation rate. But today, I would say we have rather the positive side of inflation. We haven't seen yet very much impact of this inflation on rental values. And therefore, I just wanted to provide you with, let's say, the frame, the frame of interpretation, because we're going to hear about inflation in the next months, and of course we have to make some distinctions to correctly analyze it. So if we try to analyze what has been the behavior of investors, where have they shifted their focus due to the pandemic, of course, it's pretty clear when you see the graph that of course the rising star of real estate is beds and sheds. That's healthcare, that's residential. And what's interesting to notice is that it's a trend that had actually begun in 2017, 2018, and has accelerated with the pandemic. So in many respects, the pandemic has been an accelerator of former trends. Of course, we can see that hotels and retail have been badly hit by the pandemic, maybe being now some opportunities. We'll come to that. Industrial and logistics have been one of the winners in terms of allocation of the investors, and office has, of course, reduced its share of the market of investment, but still is the biggest and the most liquid and large asset class for investors. So that's mainly the landscape or the macro landscape for real estate. Now I hand it to Henri Aurélien to go deeper into the European real estate market.
Thank you, Daniel. So we'll have a quick overview on the different kind of commercial real estate market. So if we go to the next slide, you can see here, this is a map represents commercial real estate, which include offices, retail, logistic, services, and residential. 380 billion were invested in 1921, a 23% increase over 1 year. As you can see, 2021 was a very good year for investment. The biggest market of this year was Germany, the UK, France, Sweden. And if we go to the next slide, this graphic represents the breakdown of real estate investment by country. And you can see that Germany, UK, France, and Sweden represent more than 70% of the investment market. Now let's have a look on the next slide. We'll see offices. So here, what is interesting to note is that investors' allocation remain stable over 1 year with 918 billion euros invested. Germany, the UK, France, and Sweden represent more than 70% of the volume, and you can see it's almost the same volume in this on the three big markets. On the next slide, we'll have a quick view of the prime yield in the different markets in Europe. The minimum, it's in light green. In dark green, you have the maximum of the yield during the decade. And in blue green, the yield in Q4 2021. Here, what is important to note, it's the most attractive markets, so yield compression over 1 year. In the core office cities like Paris, Munich, or Berlin, yields are below 3%, and this is due to the flight to quality toward prime office building. On the next slide, we'll have a quick view of the take-up in Europe, and here you can see that in the market we analyze, take-up was nearly 30 billion square meter in 2021, a 20% increase over the year. And the reason of this increase, it's the recovery in job creation contributed to this rebound. On the next slide, we'll have a focus now on the healthcare market. So here you have the map of investment volume in healthcare, which include senior housing and nursing home. And despite the attraction of healthcare in Europe, the lack of supply limited the transaction in 2021, with 8 billion invested during the year, which was volume stable over 1 year. On the next slide, we'll see the prime yield. And here, the prime yield of healthcare saw compression in several European countries in Q4 2021, especially in Germany, but Florian will talk about it soon. On the next slide, we can see the residential market. It's very interesting here to note that the block residential had a very good year with the same volume as offices, with 18 billion euros invested. Germany was way ahead, boosted by Vonovia acquisition. On the next slide, we see the prime yield, and here the prime yield on residential no compression over 1 year, as you can see on this graphic. Cities like Paris, Munich, and Vienna had prime yield below 3%. On the next slide, here there is residential prices, and we can see that the residential prices were still rising across all markets analyzed in Q4 2021. On the next slide, we'll have a look on hotel investment. The hotel sector saw a significant rebound with a 62% increase over 1 year. Capital concentrated change a little bit compared with the other map we saw in this presentation, because of course you still have the UK, Germany or France with big countries, but we can also see that Spain and Italy are quite important too. Now let's have a look on prime yield. Hotel prime yield had to figure out a correction between 2021 and 2020, except in the most prime market like Paris or the big cities in Germany, for example. On the next slide, it's about the indicators, the performance indicators in Europe. And as you can see here, occupancy rate, average day rates, and the RevPAR, which is the revenue per available room, all these indicators rose because of the good summer season in 2021. On the next slide, we'll have a focus on retail investment on retail market. On the next one, We know that retail investment realized 34 billion euros invested. Investors are still selective on this asset class. The UK and Germany are the biggest market, as you can see. Regarding now the prime yield, it's if the very core market were stable during the crisis, other markets had to figure out correction between 2021 and 2020, and this is due to the corona crisis. So now I will let Florent continue.
Yeah, I will. Sorry. Now that we have all the figures of European real estate markets in mind, we're going to focus on the three, I would say, the three main plays that Primonial REIM has done in the last years quite successfully, which are healthcare real estate with a focus on Germany, Parisian offices, and European residential. These are, let's say, I wouldn't say bets, but I would say convictions that we have had for healthcare since 2012. Paris offices since the beginning of Primonial REIM in 2011, and European residential since 5 to 6 years from now. So we're quite happy that the market has in some sense confirmed the convictions we had on these asset classes. But we're going to focus on each of these plays, and let's begin with Florian Wenner from Frankfurt, who will talk to us about the German market from healthcare and the general sentiment of the German market.
Yeah, thank you very much, Daniel, for this nice introduction. Yeah, as time is short, I will directly start with my presentation. And as already mentioned, today's topic is going to be the German healthcare market. And I would like to start with this small slide showing the German Real Estate Climate Index to give you a short introduction of the German market. So what you can see there is a climate index that is a survey-based sentiment barometer of the German market. So to explain you a little bit the methodology, what is important to know, it is survey-based. So every month, a specific group of real estate professionals are asked about their opinion on different asset classes and their general market opinion. So this survey or this climate index works as a sentiment barometer and can also indicate potential turning points or future developments in the market. So if we look now into more detail, we see that the scale, oh no, you can please go back to the slide. You can see that the scale ranges from 0 to 200, and values over 100 signal a positive view on the market. If you look on the right, we see more or less three different groups. On top, we have logistics and residential, which is mainly the same picture than in Europe, as Henri mentioned. In the middle, we have the office sector with a value over 100, so still positive view. And at the bottom, we see hotel and retail, two asset classes that, as we all know, were heavily affected by the pandemic. So now you might be wondering, where is healthcare in this overview? And yes, you're right. It was not a mistake. Healthcare is just not part of this climate index. And this already illustrates very well that healthcare is still considered to be a niche market and receives less attention than other asset classes in this general market overviews. And now we come to the next slide and see one of the reasons for that. If we look at the share of transaction volume by asset class, we can see that, in fact, until 2015, healthcare, which is on the very top of these shares, accounted for less than 1% of the total transaction volume in healthcare. But if we now look also on 2016, there was a little turning point, and healthcare began to rise also in this share distribution. For example, in 2016, it accounted for 5% of the market. In fact, in the last 2 years, healthcare was even able to outperform the hotel sector in terms of transaction volume. So maybe it is time to change the climate index and add healthcare finally in it, as it really became an asset class, an important asset class in Germany in the last years. So now let's come to the next slide and look a little bit more into detail into the German healthcare market in the last 10 years. What you can see there on the left side is the transaction volume in healthcare market from 2012 to 2021. As already mentioned, we see that until 2015, the healthcare transaction volume was still on a very low level. So in fact, as Primonial or former Avia Rent even started to invest in healthcare before 2012, in this time, there were really just a few investors in the market. And so Primonial can really be seen as a pioneer investor in German healthcare market. The same picture as before, we see that in 2016, the transaction volume has risen sharply on a level of 3 billion euro per year and remained on a high level in the last years of around 2 billion euro. But what illustrates even better the growing importance of healthcare in the last years is the yield development from 2012 to 2021. So if we now look at the years 2012 or 2013, we see prime yields for nursing homes of around 7%, which from today's perspective seem nearly unreal, as prime yields now has fallen below 4%. So as in other asset classes as well, we saw this huge yield compression in the last years. If we look on the right side, we see one of the reasons for that. What you can see there on this little donut chart is the buyer's composition in German healthcare market on a 10-year average. What becomes clear there is that we really have seen an increased interest of foreign investors in German healthcare market. So as a matter of fact, more than 50% of the invested volume came from foreign investors. So we can say that foreign investors really put an eye on German healthcare market, which normally is a good indicator for the attractiveness of an asset class. So now come to the next slide. We turn now a little bit to the outlook of healthcare. Before I talked about the development in the recent years, and now let's look a little bit forward. So of course, as always, we have opportunities and challenges that we will face in the coming years. So if we look on the right side, we see some headlines that I put together for the challenges or to illustrate the challenges. So surely you have all noticed that more and more investors see opportunities in healthcare, in the healthcare sector, especially or often also in context of an ESG strategy, as healthcare is considered a very ESG-friendly asset class. So we can be sure that in the coming years, we will have high competition in the healthcare sector. Another challenge we will have to face is the shortage of nursing staff. So operators in Germany are already desperately seeking qualified nursing staff. So we can be sure that without migration from abroad, this gap will be very difficult to fill, especially in the context of the demographic development. One other aspect that is always important to mention is when you invest in healthcare, there's also a reputational risk that you're confronted with. The care sector somehow is always part of public debate, and therefore also healthcare investors sometimes are confronted with questions that mainly concern the operator, but therefore it is important for investors to have a good knowledge of the operator market to address this communication question. So let's look on the left side, and there is one major opportunity that healthcare market, especially in Germany, but also in other European countries, is offering us, and that is the demographic development. So we are confronted with a demographic development that will lead to a significant increase in the age group of seniors, which as a consequence will increase the number of persons in need of care. As you can see in the graphic, it's especially about the very elderly people in the age group of 80 or even over 90 years old. So at the same time, this demographic development is confronted with a shortage of nursing homes and care beds in Germany to meet the increased demand. So we can be sure that if the building activity stays on the same level as in the last years, we won't be able to fill this gap. In any case, we definitely see high demand for care beds in Germany, thanks to the demographic development, which is in fact a very positive outlook for investors. And now I come to the end of this short overview of German healthcare market. And well, looking at this longer list of challenges, I come to the conclusion that we can say it will be definitely more challenging in the coming years than it had been in the last years for healthcare investors. But now, and it's always important to finish with a positive message also for our investors in the audience, I can tell you that Primonial REIM is currently the biggest player in German healthcare market. And we can see that this market will be a market for professionals and experts. And I promise you, you're in very good and very professional hands with Primonial. And with that, I pass back to my colleague, Daniel.
Thanks, Florian. Thanks very much. Healthcare is indeed a fascinating asset class. We remember some conversations a few years ago where people told me, healthcare is very long leases. You don't have any asset management to do, etc. I can really assure you, as Florian pointed out, that it's a market for professionals, and I would say also that size matters a lot in that market, because clearly, if you want to have a balanced relationship with healthcare operators, it's important that you're a big landlord to them, and that's the position we are in today. So now I'm going to focus on Primonial REIM's main share of its portfolio, which is French and Parisian offices. And of course, I'll comment on offices in general, but I'll try to focus on the Parisian market. So just to remind you of, let's say, the key figures of the Parisian office market, of which you have a representation here. It's by far the biggest, largest market in offices in continental Europe, 54 million square meters, about 20 billion investments in Paris, in Parisian offices. And I would say what's really a feature you should keep in mind on Parisian offices is that, of course, it's the largest market, but it's especially the most diverse in terms of the tenant structure. We all know about the London market, which is of course, very sizable, even though it's not European anymore in terms of institutions, but it's a very sizable market, but very concentrated on finance, on technology, media, telecommunications sector. Whereas in Paris, you've got really a great variety of tenants. You've got lawyers, advisory companies. You've got big public companies. You've got all sorts of tenants and all sorts of, let's say, real estate formats. You've got La Défense, which would be the equivalent of London's Canary Wharf, with very it's a business district really, with very high towers. You've got, of course, the Paris intramuros, which we all have in mind with these very specific Haussmannian types of buildings. We've got a lot of new developments around Paris within the framework of what we call the Grand Paris project, which is the most massive infrastructure project in Europe nowadays, and which is meant for the 2024 Olympics, of course. So we've really got to, I would say that clearly Parisian offices today is the most liquid and the largest market in continental Europe. Of course, it's also because France is very centralized around Paris. So 85% of tenant activity is in the Parisian market. So that makes Parisian offices a big player. Now, if we go deeper into the current situation of rents, it's interesting to see that until, let's say, the pre-pandemic, let's say until fourth quarter 2019, there was a sort of let's say convergence between rents in new offices and second-hand offices. That's a bit of an indicator of overheating. And since the pandemic has taken place, we've got a sort of differentiation, which I believe is quite natural and quite good news between rents of new offices and rents in existing second-hand building. But we also can see the rise of the incentive rates. So the incentive, what we call incentive rates, it's the concessions we make to tenants to keep them, and clearly they're an indicator of the relationship between tenants and landlords. And when these incentive rates tend to rise, that means that the landlords desperately need to keep their tenants in place, which is, of course, the consequence of the pandemic. We'll come to that in a minute, and therefore we have to monitor these incentive rates and try to be in a position where we don't have to renegotiate leases in these periods where incentive rates are very high. Next slide, you can see the cause for of course this tension on real rents, which is supply. Of course, the supply, the vacancy in the Parisian market is overall 6 to 7%. So it's not huge. It's not problematic rate of vacancy. In Paris intramuros, you've got 2% vacancy. Okay, so really in Paris intramuros is really full. Basically, it's full. We've got some other sectors like La Défense, like the north of Paris, where you've got certain amount of new construction of developments, and that's where the supply is coming from. And we can see that really, of course, supply has risen in 2020, 2021, but over the last 3 quarters, we can see that supply has stabilized around 4 million square meters, and that to us is an indicator of recovery. That means we probably ahead of the curve, and we probably going to stabilize the situation. Now, if we go to the next slide and take a more prospective view on, of course, what everyone has in mind, which is working from home, remote working, how it affects the office market. I think it's useful to note for the international investors who attend this meeting that there's kind of an exceptionality of France regarding remote working. Of course, this also has to do with the way the pandemic has been managed, but it's also a reflection of the relationship of French employees and their offices. Clearly, the French, compared to Germans, Italians, Spanish, and British, have been less working remotely than their counterparts during the pandemic, and if we believe these surveys, clearly there's less demand from French employees for let's say 4 days or 5 days of remote working. Basically, the consensus is around 2 to 3 days a week, massively in French companies. That's for many reasons, some of them cultural. The main one being, in my view, that of course the prices of residential are such that of course the alternative between less square meters at home and the office is less attractive in favor of working at home. So that's it, from the point of view of an investor, is some kind of I wouldn't say insurance, but some kind of protection. But if we go to the next slide, it's really important to note that of course we can't stay on the same kind of offices that we have had for many years. We believe at Primonial that the next generation of offices, which of course already exist, but what we really have to orient our portfolio to is offices which are more collaborative. We think of offices as a social network. That means that in new headquarters, especially, there's all this interest of having more meeting rooms, having greater variety of places where you can work, when you can gather, when you can communicate, and that means that the key issue for offices is flexibility, and therefore we have increased our focus. It was already a bit of our specialty at Primonial REIM, but we have increased our focus towards headquarters, because if you're flexible, you need to be big, modern, flexible, and oriented towards, let's say, team building offices. And that means going, of course, more into new offices, new developments. Haussmannian kind of offices may be a bit challenged because, you know, a lot of lobbies, a lot of square meters that are lost, etc., etc. So really, there's a special vigilance to have over the way offices play with their square meters and the flexibility they offer. So that's typically images from the headquarters of Nestlé, big French company, of course, that Primonial REIM has purchased last year in the West Crescent of Paris offices, and that's in Parisian market, and that's typically the kind of asset that we are looking for right now, and we're very positive on offices when it comes to offices who increase the productivity and the attractivity towards employees. Now I hand it to Henri Aurélien. We're going to focus on a big line of work for us, which is a residential market across Europe. And of course, it's a very complex topic. So we have built, let's say, an in-house model to analyze these markets. And Henri Aurélien, I leave you the floor so that you can present it to us.
Thank you, Daniel. I will present you a big study that we made in residential for Europe. This study, it's possible to find it on our website. So here it's more a synthesis of this study. What I can say about the top trend on residential in Europe, it's that we identified 4 mega trends in Europe with different variables. It's, for example, demographic trend with strong demographic pressure, demographic shift with the aging of the population. There is also the side with the urbanization. We'll have a little focus here on infrastructure, the transportation infrastructure. There is also sociological trends with the new generation who have new expectations. There is also the change in household composition. And the last one, it's institutional on the residential market with the increase of the block sales. But this, we almost already saw it in the beginning of the presentation, so I will not make a focus on it. So the idea of this was to analyze all the data related to these mega trends and to create an index to help us to categorize the different markets in Europe. If we go on the next slide, here there is a focus on demographic challenges. And as you can see, even if we have a growth of the population of the EU during the next decade, between 2020 to 2030, when we analyze country by country, we can see that the growth will not be the same in Europe. So this is important for an analysis. The other thing is that the demographic pressure creates chronic undersupply in Europe on the residential market, and especially in big cities. If we go on the next slide, here, as I told you, we realize a focus on transport. And what is important to keep in mind is that research shows that the creation of a new public transport network and new stations increase demand for housing in this new area. And the creation of the new station can result a 40% increase in real estate prices in some cases. So this means public transport are quite important, right? We have analyzed this public transport network, metro and tram, of 140 cities in Europe because we wanted to identify opportunities. So if we go on the next slide, here you have a focus on what total return projection we can expect to 2023. How conservative, and I think it's important to say that we are very conservative regarding forecasting with our model. For the total return of residential in the Eurozone, our model suggests average annual increase of at least 4% between 2021 and 2023. As you can see on this map, the best oriented markets to 2023, it's countries like Germany, the Netherlands, for example. In the average, you have countries like Spain or Portugal, and below 4%, it's countries like France or Italy. However, it's really important to keep in mind that the area, the risk of correction in value, it's here, and especially with the increase of interest rates. So on the next slide, you have here what we call the Eurocity ranking. So what is the Eurocity ranking? As I said in the beginning, we have developed a specific index to support decision-making in the implementation of an investment policy, and we call it the Eurocity ranking. So we have analyzed more than 130 cities in Europe with 5 main groups of indicators. The first one, as you can see, it's demographic. So we analyze all the indicators about demographic, housing access conditions, real estate, economic, and transport. And if we go to the next slide, all these big indicators, we have attributed scores for each market analyzed. And the model identifies 3 main categories. The first one, it's what we call the tier 1 countries. It's in the gray, which is cities with a good risk-return profile, and the score is the highest on these 3 categories. The second category is tier 2 markets with a good risk-return profile, but with the score a little bit lower than in tier 1 markets. And the third one, the tier 3, we have identified different risks compared to tier 1 and tier 2 markets. And our model suggests that for the best allocation, it's interesting to manage the risk-return profile and to have a global allocation in Europe to try to have the best risk-return profile portfolio. This is what I can say about residential.
Yeah, thank you, Henri. Thank you, Danielle. Thank you, Florian. We have covered a lot of topics today. We got some questions, and we have a little bit time to try to answer these questions. However, the first one is a question that probably would cover an entire webinar. What is the impact of on healthcare due to the au pair case? And I'm not sure that everybody is aware of this, especially outside of France. It's a discussion about one of the largest operators in Europe, about the bad treatment of elderly people in the nursing homes. It's a topic that will continue to exist until the end of the presidential election campaign. We have to say, well, our exposure to au pair as an operator is extremely small. I would say the effect is more a reputational effect right now as a financial one. The lease, the rent amount is a small portion of the cost of an operator. But I would say we follow this topic, and we may cover this in the next webinar. As I said at the beginning, we will have a series of webinars every 3 months. We do one, and we will cover this going further. So another question is about whether we are looking to invest in the healthcare market in UK. The answer is, I hope so. We are looking at this market very intensively right now. We know healthcare very well, and we are interested in one of the largest markets, which is UK. However, we have to measure the impact of hedging cost on the returns. So I think in a couple of weeks we will make our mind and decide how to deal with this topic. And but the answer is yes, we would like to go. And another question, also a question that probably will fill an entire webinar, but what is the decarbonization policy of Primonial REIM? Maybe Danielle in 2 minutes.
In 2 minutes, I'll try to make it 1 minute 30. Yeah, we of course we're committed to net zero by 2050, but we know that's a general statement. Our decarbonization strategy is basically what I would call managed to green, right? We're not building or selecting only green buildings. It wouldn't have no sense. We were core investors. We were an income-driven investor. So basically, we have this managed to green approach or best in progress approach, and what we want, of course, we've integrated 2 years ago ESG due diligence, including climate, into the selection of our acquisition. And right now we have over 14 billion euros of assets, more to be compared to the 32 that mentioned Jürgen earlier, which are what we call ESG managed, which means with an ESG score that we try to improve over time. So our decarbonization strategy is basically to progressively reduce carbon emissions with yearly annual targets. On the long term, we're on the 1.5 trajectory, and we've incorporated all the procedures, including engagement policy, in this respect, and we're also one of the biggest certified funds owner in France. We have the label ISR, which is a green certification for funds, and we currently one of the biggest players in that field.
Thank you, Daniel. A question about return rates back to the office statistics. I think we certainly have information. We will check and provide this to you if available. In general, we will send you the slides of this webinar to all participants in due course. And with that, I would like to thank everybody, not only listening, but also everybody participating, Daniel, Henri, Florian, and especially our marketing team for preparing this webinar, and especially thanks to all of you. If you have questions, please ask them also after this webinar. There is an email address that we just showing on the screen. With that, in order to stay on time is essence. Thank you very much for your attention, and hope to see you in May in our next webinar. Thank you very much.
Thank you.
Bye-bye.
Bye-bye.